Rupesh Patel, the Senior Fund Manager, Equity Investments at Nippon India Mutual Fund, is now with us on the show now. Rupesh, thank you for patiently waiting by. Thoughts on the markets now and the kind of positioning that you would recommend. What are the sectors that you're bullish on right now? What are the sectors that you have avoided, and any tactical shifts that you've made in your mutual fund?
Sure. Thank you so much for having me on the show. So, in terms of sectoral positioning, we have significant overweight on financials in our portfolio, and within that, banks and large banks, they are the significant overweights. And the thought over here is that if we look at large banks, then in current environment when interest rates are going up, they have strong CASA franchisee, which helps them in terms of their cost of funding. If we look at credit costs, then the NPAs of last cycle, they are very well recognized and provided for. And broad economic momentum in India seems pretty good, and we do not feel that in the near term there is any risk as far as credit costs are concerned. They are well capitalized, ROA are healthy. In fact, we are seeing that some of the provisions which these banks had taken in last few quarters, they are getting reversed as credit quality turns out to be better than what was expected. So we believe net, I think financials and within that large banks are very strongly positioned. Credit growth, it is becoming more broad-based. Margins are likely to remain stable or marginally expand. And hence, we have overweight stance as far as financials and banks are concerned. In terms of avoid, we have generally, tended to be underweight on sectors, companies which have global orientation as far as their growth is concerned. So one sector where we are maintaining, we had and we still continue to have underweight position is information technology. These companies did very well in post-COVID world because it was expected that their growth profile will significantly change in the post-COVID world. And there were obvious margin tailwinds as well. As we move ahead, as there are concerns on slowdown or recession in developed world, IT budgets, there seem to be some uncertainty around that. So considering the risks involved, this is one sector, and generally companies which have global orientation, we have underweight stance in our portfolios.
Okay, underweight IT, overweight financials. By the way, the market breadth has decisively swung. We are 1,200 stocks plus lower. It's not a huge gap, but losers outnumber gainers by about 300 odd names now. It was exactly 1:1 when we started the program at 2:30. Rupesh, how much more broadly as you think about IT services before they get into what you would describe it as an attractive, viable kind of zone?
Yeah, sure. I think if we just go back maybe 2 quarters or so, the valuations of IT companies, they were reflecting expectations of meaningful acceleration in their earnings growth. And there was some kind of extrapolation in that growth numbers which were reported by companies. We have seen valuation correction happening there. And in some cases, even earnings are getting revised downwards. We believe there is still some way to go as far as earnings revision is concerned. I think and coming quarter, in any case, it is expected to be relatively weaker quarter. But a lot depends on how commentary, comes from IT companies, particularly on IT budgets. Going ahead, that's something which will get an idea early next year only. So I think there is still some way to go, at least in terms of earnings expectations getting moderated.
Rupesh, what if these stocks correct but a good 10-15% from here, which it's not unlikely to happen. It could possibly happen if the globe goes into a bit of a tizzy. Would you then change your underweight stance? That's on IT, and I believe you also like auto, or the auto space. What do you like out there?
So we would selectively look at, adding, as the valuation expectation, as the valuation or earnings expectations they moderate. Definitely this sector, will have good exposure in our portfolios, because all said and done, these companies, they are good quality companies. They generate healthy cash flows, and if you look at the return ratios, they are capital users. They are efficient users of capital. So I think, they would find exposure in our portfolios. So at certain correction at some point in time, obviously they would start looking attractive, and we would look at adding them to our portfolio. As far as auto sector is concerned, we have some exposure combination of OE as well as some select auto ancillaries over there. Within that, I mean, more from a near-term perspective, more positive on passenger vehicle segment. And we believe that in the near term, there are some tailwinds on account of commodity prices correcting over there. So yeah, I mean, on selective basis, PV is one segment where we have some exposure.
Broad consensus is that because there is so much global uncertainty, there is relative comfort on the domestic demand. And in that, a lot of people are also bullish on cement. But the two numbers that we've got today, ACC and Heidelberg, have missed street expectation, and margin pressures are real. The kind of fuel inflation we've seen, the increase in cost of production, etc. In that context, what would your thoughts be on cement? And is the street over expecting, being too bullish on cement? Could things get worse for them on the margin front?
I think current quarter was expected to be a weak quarter on account of inflation in fuel prices, which we have seen. But going ahead, I mean, we have seen petcoke prices correcting from their highs. I mean, though they still continue to be higher than what they were before the crisis started. But going ahead, we expect that the margin pressure which we are seeing in this quarter should start reducing as far as demand is concerned, with infrastructure investments picking up, real estate sector expected to do well in terms of demand. The demand side should also start looking up. So as far as demand is concerned, as far as margins are concerned, I think outlook is better over there. But as far as stock prices performance are concerned, I think one factor which we'll have to watch out for is what happens to realization. So that's something which we need to watch out for, as far as, I mean, which would be an important factor to watch out for as far as performance for cement stocks is concerned.
Okay, all right, Rupesh, it's good hearing your thoughts. Thanks so much for stopping by and filling us in with a whole host of sectors that we did discuss. Wishing you a happy Diwali in advance, and appreciate your time here on CNBC TV 18.